Hi, everybody. This is Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 54, titled Selecting the Best Strike Prices for Our Collar Trades. And we're going to use a real-life example with Advanced Micro Devices, Inc., which trades on the NASDAQ exchange under the ticker symbol AMD. Let's first start by defining what is the collar strategy. And this is a strategy that has three legs incorporated into it. It basically starts out as a covered call writing trade, and then we add a protective put. That means there are three legs to this trade. We are long the stock, so the first step is then to buy the stock. And then we sell generally an out-of-the-money covered call. And that is the covered call writing aspect of the trade. Now, the third leg involves purchasing an out-of-the-money protective put. So out-of-the-money for puts means below the current market value, and out-of-the-money for calls means above the current market value. So the trade then has both a floor, which is the put strike price, and a ceiling, which is the call strike price. Let me first give a hypothetical example, and then we'll move on to a real-life trade with AMD. Let's assume that BCI is trading at $58 per share. Well, we go ahead and purchase BCI in 100-share increments, and then for this hypothetical, we're going to sell the out-of-the-money $60 covered call for $1.50 a share, or $150 for the contract. So that's the covered call aspect of the collar trade. Now we're going to add in the protective put. So an out-of-the-money protective put, let's assume at $55 strike, let's say it costs us 75 cents to purchase that put. So how do we know if this combination of strikes is appropriate for our trading style? Well, what we have to do is first define what our covered call writing goal is. And then we have to deduct the cost of the put from that and come up with a new lower goal for the collar strategy. Let's assume for a moment that our covered call writing initial time value return goal range is 2% to 4% per month in normal market conditions, and we're willing to go as high as 6% in bull markets, but no higher. The reason why we don't want to go too high with our initial time value return goal range is that the higher we go, that's greater implied volatility for the underlying security, which means more risk. We have to keep in mind that covered call writing, or put selling for that matter, are low risk trading strategies. So we don't want to convert them into a high risk trading strategy by using very high implied volatility underlying securities. So if that's the standard we set for covered call writing, we have to lower that for the collar trade because we're incurring a debit on the purchase of the protective put. So let's assume for a moment that we want to set a goal half that of our covered call writing goal. That would bring it down to 1% to 2% in normal market conditions and up to 3% in bull markets. Now, of course, in a bull market, we may not need a protective put, but that all depends on the investor's personal risk tolerance. So that would be how we would formulate our initial structuring of the trade. Now, if we fed this information into the BCI collar calculator, we would see, given these stats of the 60 call generating $1.50 and the 55 protective put costing us 75 cents, that would result in a 32-day return of 1.29%. If the price of BCI moves up from 58 to the 60 call strike, that means our initial 1 month return would be 4.74%. Now, what if BCI moved down to and below the 55 put strike? Well, there we would be incurring a loss of 3.88%. So that just shows you how the initial trade is structured. It doesn't explain or tell us what the final outcome is going to be. Let's now look at an option chain using a real-life example for AMD. Now, at the time that I'm creating this video, AMD was trading at 77.43. And we're looking at a 1-month option chain. So the call side is going to be out of the money or higher than 77.43. And the 79 strike at the time had a bid price of $4. Now, if we looked at the put side, we would look for a put strike that generated about half that amount, half of $4, about $2. So we see from the option chain that AMD, the cost of the 70 put was $2.16. So we're going to check that out by putting this information into the BCI collar calculator, and we're going to see what the results are and if it meets our stated goals. So once again, the call premium is 4 and the cost of the put is $2.16. Now, if we were to look just at the covered call writing aspect of the trade, with AMD trading at 77.43 and a $4 premium, we would see that the return on our option or RU is 5.2%. We might use this strike in a bull market environment, using 2 to 4% normal markets and up to 6% in a bull market environment. So this would be appropriate more in a bull market environment. Now, also, the 79 strike allowed us some additional share appreciation if AMD moved up from 77.43 to the 79 strike, and that would be 2.0%. So there's an opportunity for 7.2% 1-month return with this trade. But this turned out, we're looking at it from the perspective of a collar trade, not a covered call trade. So we have to add in the cost of the protective put. So if we feed this information into the BCI collar calculator, we would see that the initial time value return is 2.79% for 1 month. Now, if AMD did in fact move up from 77.48 to the 79 strike, then the return would be 4.82% for the 1 month. Now, what if AMD moved down below the 70 put strike? Well, then we've incurred a loss of 6.81%. Keep in mind, these are the numbers without any exit strategy executions. So, folks, let's summarize this podcast now. Collar strikes are both generally out of the money. So for calls, higher than current market value. For puts, lower than current market value. We must first set our initial time value return goal range for the covered call writing aspect. If we don't know what our goal is, how are we going to know what options to select? Now, once the call strike has been set, the put premium should be about half that of the call premium. All right, these numbers can be tweaked based on what your strategy goal is and what your personal risk tolerance is. But this is a very good guideline to go by. And this guideline, the results of this can be supported by just looking at an option chain. So first we say, well, we're looking for a 2 to 6% return on the call. Okay, $4 does meet that requirement. And then the put premium, we want to pay about half of that amount or less. And so before I go, folks, I want to just remind everybody, as I always do on these podcasts, the tremendous amount of free resources available on the bluecollarinvestor.com website. Look at the top black bar of our web pages to click on that free resources link. There's a free covered call calculator we call the Ellman calculator, and there's also a free put selling calculator, single column. For those of you who are premium members, you get the expanded versions for free as part of your membership. We also have a litany of blog articles, as well as the Beginner's Corner tutorial and some free videos. So there's a lot of free information on www.thebluecollarinvestor.com. Now, if you click on the store link, you will see that we have various versions of our 7 published books in the form of ebooks, soft cover. Some of them are in hardcover version. We have online streaming DVD programs, a lot of video lessons, calculated spreadsheets, and as well as the trade planner and online mentoring program. So check that out on the bluecollarinvestor.com store. So folks, that ends this BCI podcast number 54, selecting the best strikes for our collar trades. If I come up with other examples, which I know I will in the future, I'll be happy to share those collar trades with you as well. Thank you so much for taking the time to listen to this podcast. Hope you enjoyed it. And most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.